Hey guys, what's going on? My name is Steven. I'm here with Paycheck to Paycheck, and in today's video, I'm going to be talking to you all about something that makes absolutely no sense at all, and that is wearing a dress shirt, a tie, and some shorts. In all actuality, in today's video, we're going to be talking about something that makes equally as much sense as that, and that is financial terms. And the reason for this is because it does really no good to be talking about all these financial terms if we just don't have a baseline for what these terms actually mean. So then, without any further ado, let's just let the music roll. If you understand what these terms mean, whenever you're trying to learn about finances or anything else that you're trying to do, it just helps make much more sense to just know these different terms and what they mean. In today's video, we're going to be discussing several financial terms such as a REIT or a real estate investment trust, a stock, an asset, a liability, bonds, ETFs, mutual funds, IRAs, and other retirement accounts such as your 401k, taxes, and then just what the word investing means. We're also going to talk about interest and credit cards and other types of loans. With that being said, let's start with an asset and a liability. Simply put, an asset is something that you own that makes you more money. And a liability is something that you own that costs you more money. So an asset can be something like a stock, it can be a dividend stock, it can be real estate. Really, an asset is something that, simply put, just puts more money into your pocket, and a liability is something that just takes money out of your pocket. Now, a REIT is a real estate investment trust, and what this is basically, it's a company that's a fund, and in that fund, what it does is it holds certain real estate assets, and it has to pay 90% of its profits back to its shareholders by law in the form of a dividend. So what is a dividend? And basically, a dividend is something that a company pays its shareholders as like a share of the company's profit. You can think of this like McDonald's. If you own McDonald's and they're paying you a dividend, basically what that is every time McDonald's makes a profit off of the hamburgers, then you're getting a share in that profit that the company is essentially making. So that's basically what a dividend is it's just a company that you're buying, sharing its profits back with you, and generating you some actual cash flow. That way you have something other than just the capital appreciation or the increase in the value of the stock. So then what is a stock? Simply put, a stock is a partial ownership in a company that is like publicly traded, really just any company. All companies have stock, and if it's publicly traded, then you can buy shares of it on the New York Stock Exchange or really any other stock exchange. And this is awesome because you can buy ownership in just about any company out there, and whenever that company makes a profit or whenever that company just does better, then you get rewarded in the long term. That being said, now let's talk about different types of funds. So there are ETFs and there are mutual funds. So what is an ETF? An ETF is an exchange traded fund. And basically, it's a fund that holds a bunch of different stocks, and so it'll track a particular index. There are ETFs that will track different parts of the economy, and that's what an index is. So different parts of the economy such as oil, gold, real estate, healthcare, technology, anything that falls into like its own niche category in the overall economy, that's going to be an index. So an index fund is going to follow the basic returns of that overall index. With an ETF, what you're doing is you're buying several hundred, maybe even thousands of companies all under one stock ticker. Take, for example, VTI. VTI is Vanguard's total stock market, and it holds like 3,500 companies. So whenever you buy shares of VTI, what you're doing is you're buying ownership in 3,500 companies. Every dollar that you put in is getting spread out among all those different companies. That gives you some diversification. So what is a mutual fund? Mutual funds were made kind of popular by like Dave Ramsey, and what they are is basically whenever you go to like a broker or something like that, then if you invest in a mutual fund through that broker, what he does is, let's say he has 100 people that are bringing him money to invest. So what he'll do is, if he's investing in mutual funds for you, he's going to pull all 100 of those people's money together, and then he's going to use that pulled money to buy stock. And that's going to basically track an index. It's going to be similar to an ETF. But a mutual fund is basically, the broker is ultimately going to be getting a commission off of that. Whereas an ETF is usually going to have a much lower expense ratio. And an expense ratio simply just means what your broker is charging you to buy or sell stock. It's their commission. So now that we've talked about that, let's talk about the individual retirement accounts, or IRA. An IRA is an individual retirement account, and basically there are two different types. One of them is a TD IRA, or a traditional IRA, and the other is going to be a Roth IRA. So a Roth IRA, basically, Roth just means that it's going in after you've already paid taxes on it. So let's say you're working a job and you make $1,000 in your paycheck and you're taxed at 20%. So you're left with $800. So if you take that $800 and you put it all into your Roth IRA, then all of that is going in there after you've paid taxes on it. The other $200 already went to our favorite uncle, Uncle Sam, and we're going to be talking about him in a minute. Anyway, that money is going into your Roth IRA after you've paid taxes on it, and then it gets to grow without you ever paying taxes on it. And because it's money that you've already paid taxes on, it's going to be more lenient for you to withdraw from it. However, you may be subject to a penalty. It really just kind of depends, but a Roth IRA is going to grow 100% tax-free for you. As long as you are pulling that money out in your retirement. So other than that, you have a TD IRA, and a TD IRA is going to have much stricter withdrawal requirements than your Roth IRA is. But what a traditional IRA is it's kind of like another type of retirement account that you can get set up. And I like traditional IRAs because they can invest in a broad category of things. You can own real estate in a traditional IRA. You can move your 401k after you leave your employer over to a traditional IRA. And then you can move those funds from the traditional IRA into the Roth IRA by doing the Roth IRA conversion. And that can really help you to save a whole lot of money in taxes on money that you haven't paid taxes on yet. Because typically this money is going in before you even pay taxes on your income. So like your 401k or anything else that's going to be pre-tax. So let's say you're making $1,000 paycheck and you're normally taxed at 20%, but you are putting 20% of that into your 401k or your pre-tax retirement account. So then you're putting $200 into your account before you pay taxes on it. And so what you're doing is you're only going to be getting taxed on that remaining $800. So then you're only getting taxed 20% of $800, which would be about $160. So then you're saving yourself $40 in taxes every time you do this, if that's where your tax rates are. So then that money that you're putting away, that $200, is growing tax-free. You're paying less in taxes, and then whenever you move that money over, you're going to be paying less in taxes on that anyway. And then it gets to grow 100% tax-free in the Roth IRA, which is really making the most out of your retirement account and every dollar that you're going to work for. So the next retirement account that we're going to be talking about is the 401k. And the 401k is a retirement account. They're really not, in my opinion, the best types of retirement accounts. However, they can be very powerful if you use it correctly. So with a 401k, it's going to be employer sponsored. So your employer is going to provide you with this retirement account option, and your employer is going to choose which funds that 401k is invested in, or which assets that fund holds. You typically get to choose what you want to go with as far as like their different investment options, but they usually have an outside company handle what all of that fund buys and owns. But your employer will usually match you a certain percent. So whatever your employer matches you up to, if your employer offers a 401k and you're eligible for it, at the very least, I would make sure that you are matching your employer's match. So if your employer matches you 2% and you're still trying to pay off debt, then go ahead and just put your 2% in, because then you're going to be getting 4% and you're going to be doubling your money. You're going to get 100% return just off the employer contribution. We've already talked about how you can use the tax advantages of that account to your advantage. So the next thing that we're going to talk about, investing. What does the term investing actually mean? And basically what an investment is an investment is something that you're buying with hopes of your underlying capital going up or having a return on your money. So let's say I buy 100 shares of company X for $1 a share. So I just spent $100 buying this company. So I own 100 shares of this company, and I'm hoping that this investment that I've bought will over time go up in value. So after a year or two, if that company is now going for $5 a share, this is all just simple examples, but it's to just get the idea into your head and just kind of understand where you're going with it. And then the next thing we're going to talk about is going to be interest and loans and credit cards. So what these are is, these are usually offered by like a bank, which is honestly, a bank is a private company or whatever company that you're going through to get a loan or a credit card. And what you're doing whenever you do this is you're taking out a loan against your future self and your future earnings, and you're paying this third-party company a fee to do so. So what you're doing is, a lot of these companies will try to tell you that they're providing you with this money, and honestly, if you think about it in terms of just your savings and your ability to pay off your debts, and then your ability to invest your money, what you're honestly doing whenever you take out a loan or max out a credit card and you don't pay it off, is you're literally taking money away from yourself, and you're paying interest to the bank or whatever company that let you make that horrible financial decision. And what this interest does whenever you're paying it to this bank is, the interest that you're paying them is honestly lowering your future earnings. So let's say you keep paying interest, but then you're also getting paid more at work as time goes on. And so as you're getting paid more at work, you're buying more stuff, and then you're paying more interest on this stuff, which is honestly lowering your total income. Whereas if you were to just be able to invest that money yourself and pay yourself that interest, then you're raising your total income over the long term. And I like to do this with dividends or with like rental income. And I like to do this by investing into ETFs or exchange trade funds, or buying companies that I actually understand the balance sheet and I understand the business model, and I like where their assets to their liabilities are. So that's usually whenever I'll buy an actual company. It's not because I'm taking a gamble on it, it's just that I am expecting that future earning potential of that company to go up over time. So now, let's talk about taxes and our favorite uncle. So why do we pay taxes? And basically the reason why we pay taxes is because our favorite uncle tries to act like a for-profit company and provide all these goods and services and then charge us for goods and services. But at the end of the day, the government is really a non-for-profit entity. And so because they're not for profit, they tax the crap out of us, because they are taxing us is how they are actually making their money. So they're leveraging each and every citizen's time and money to make themselves money, which they then use to fund different social programs and different government programs. Anything that's going to be government sponsored. The government also makes its money in the form of bonds, And what the bonds are is there are multiple types of bonds, but basically what a bond is a bond is a promise to pay. Because we are a debt-centered economy, and our structure of the US is in debt, that is honestly how a lot of money is made. And a bond is essentially, it's a promise to pay a certain amount by a certain date, and then they pay interest on that bond. So you can buy bonds and invest in bonds. Bonds are going to have a typically lower rate of return, but they're going to be much more stable over the long term than your other investment classes such as stocks and ETFs and mutual funds. Because they're safer, they're going to have a lower return. So lower risk, lower return, higher risk, higher return potential. So I hope I've helped to summarize this all. And just kind of make some sense of these financial terms. That way, whenever you're doing your own research or your own reading and you're trying to carry yourself forward with finances, hopefully it's not so encumbering or just as much of a headache. I hope I've helped you to understand these terms from a simple point of view. I'm not trying to explain these terms by the book. If I did, it would probably be much more dry than it is this way. This way, these terms become much more relatable and much less cumbering and much less frustrating. It makes it much easier to understand. So thank you guys so much for tuning in. And remember, if you never stop learning, then you will never stop earning.